Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 121. As always, joined by the three amigos, Keith Dicker, IceCap Asset Management, another new Patagucci vest, Rich Diaz, PGM Global. Hello. What's going on? Your hair's growing out like crazy.
I know my hair is a little crazy. I'm realizing. I think I'm overdue for a haircut. I'm trying desperately to pat it down, but it's not working out. It's not working.
It looks
out.
awesome though. For everyone who's listening and not watching, you know, Rich has this completely pristine white background behind him, an equally pristine white shirt, and then he has this really awesome unkept hair that's just growing everywhere.
This poofy mess. No, it's
standing
good.
out.
Great. It's a great day in Montreal. All-Star weekend.
Go Habs.
Go Habs. Yeah. No,
Are
nothing going on.
Are they going to trade Monahan at the deadline?
I really hope they don't. I really hope they don't. I know they have to because I think they made like a gentleman's agreement. But listen, I'm embracing the tank. I want us to be bad, but we're doing better than expected. But no, it's all about the Super Bowl. I think no, not yet. Next week we're gonna have a prediction, right? Keith, tell us about what's going on. You're lucky. I think you did well.
Yeah. You know,
You almost choked that one too.
Yeah,
it takes.
No, the Lions choked.
You know what? Everyone knows this, but after 60 minutes, usually the better team will win that day. So, yeah, lots of analysis this week. Next week we'll come up with an opinion and a view on what the score is going to be for the big game. 2 Sundays from now. But that was a pretty stressful weekend. Mrs. Icecap created new swear words I didn't even know existed, and she could string them together pretty well. So
you should live stream that.
There's some pretty good videos online. People just freaking out and exciting over it. But yeah, that was fun.
What's your football routine? What do? Do you crush open some Bud Lights and fry up the pizza, or what?
I don't think Bud Light is in our house. We're not exactly a Bud Light family. No, we always have good food and good drinks, and I have a big like 49ers box with all the stuff that you accumulate over the years, like little figurines, helmets, and jerseys, and autographed balls and flags and all that stuff. So you set all that up, on game day, and then you have fun. Anyway, got a big one coming up.
I have a really important question. Are you going to have a prognostication on whether or not Taylor Swift is going to marry what's his face?
That's a pretty good rabbit hole now if you go down that one. The league has a huge incentive for her to win. And anyway,
here comes the tinfoil hat.
I know it's coming out already, and we'll go into that next week. Speaking of tinfoil hats, we had the Fed yesterday, and we had Bank of Canada last week, and ECB, the Bank of England, the Swedes. They have a central bank as well, by the way. So a lot of tinfoil.
The oldest central bank in the world, isn't it? I think Swedish is the oldest central bank in the world, or one of them.
Yeah, I think it is. Yeah, that dude is pretty old.
The original swamp. Yeah, but
Isn't it
we had
funny? It's really funny how people talk about, the Riksbank, there's this Swedish central bank, as if they have a huge impact on the world, which they
How
don't,
dare you?
right?
Of course they do.
kind of like the Bank of
IKEA.
Canada.
Kind of like the Bank of Canada.
Well, but
There is-
last week, didn't Tien say that last week that, oh yeah, every meeting he goes to, everyone they ask about Canada first, and
He was being polite.
he said the opposite, actually, if you remember.
Oh, okay.
Yeah. Okay, set us up, Steve. What do we got going on today?
Yeah, just obviously the Fed, everyone's kind of watching what's going to happen with the rates. Of course, we had the Bank of Canada last week. We're seeing the articles and comments are popping up on Twitter and Reddit about, the bidding wars returning in the GTA and parts of Vancouver. So everybody seemingly is trying to front run the BOC as to when they're going to start cutting rates again. So it's interesting. We've, I can tell you this from just personal experience here in the market that the sentiment has changed dramatically. Housing is roaring back to life right now. So I don't know. We'll see how that sort of shapes up. It's interesting just to sort of see the animal spirits for Canadians, right? There's just the idea of slightly lower rates is getting people all hot and heavy. And yeah, we're seeing a lot of these bidding wars popping back up in particularly in the GTA, and people are trying to sort of denounce it, and so we'll see. We had the Bank of Canada last week. There was an interesting comment from Deputy Governor
Carolyn
Beaudry.
Rogers. No,
he's retired.
Oh, okay. I like Carolyn Rogers.
Paul Beaudry retired. So he was interviewed, I believe it was by Bloomberg this week. He says, I wouldn't see the potential rate cuts until probably the July decision. So he's also trying to front run the housing market as well. But it's interesting, like a guy that just retired, how much stock do you put on his words? He just left the swamp.
Well, it's kind of funny because he said he's expecting the first cut in June. If you look up what our financial markets expecting for the first cut, when is it, Rich? Which month?
I'm typing it up. It's the WERP.
It's the WERP. It's April or June, right? So he's in line. You joke, right? When you go to do an interview of these things. So even though he's not in there anymore, you're still, your lips can be a bit looser than they were before.
Real original, Paul. Thanks a lot.
Yeah.
So it's May. It's 97% chance of a cut.
Well, he's saying June, so there you go.
Not exactly a super heroic call from our dear deputy.
But yeah, I mean, obviously, more importantly, the BOC is a fart in the wind. What really matters here is the Fed. So we had Jay Powell yesterday. Keith, I'll let you kind of walk us through that. Some important commentary from the world's largest, most important central bank.
I know it's always exciting when it's Fed day, because in the morning, like nothing is moving. The lunchtime is still nothing moving. And then literally 5 minutes before 2 p.m. Eastern, you see markets start to move. And you're wondering, do they know something? They're starting to get whispers at what might come out.
Nancy Pelosi's just shuffling her deck.
Oh yeah, she's stocking up on calls and puts and everything. And she has a good record at that stuff.
She's an amazing record. Sorry,
I know. Yeah, I sat next to her at the football game once, and she owned, I think, 2 or 3 rows in that section, so she's having success.
Shocker.
What people don't realize as well, so you have the Fed meeting, and then you have the media. They're all locked into a room with them, and I think you have what is the media blackout. The Loonie Hour, we have that as well sometimes, right? And but they're in there for about 30 minutes, just banging away on their typewriters and everything, trying to get the story ready to go. And I think you'll also appreciate their story is probably 85% already written. They just have to change some of the, I guess, adjectives they're using and, cut to hold and stuff like that. But the big news with the Fed yesterday, and again, I think just to back up, I think we all need to appreciate that back in December, which was 5 weeks ago now, maybe in the middle of December, everyone was expecting every major central bank to start cutting by anywhere from 100 to 150 basis points this year. It was unbelievable. We hit a euphoria and a mania in that, rates are coming back down hard. And now here we are, a month later, and now we've done a round trip on that. So what the Fed did yesterday, they effectively came out and said, hey, you're all expecting us to cut in March. We might cut in March, but it's pretty likely we're not going to cut in March. We kind of like the way things were set up here. So once again, they've stayed hawkish or not dovish. Everyone's waiting for this pivot to take place, and that has everyone all up in arms or anxious and concerned. But it's sort of what's carried over the Bank of Canada last week, and same with the Europeans. Like everyone is, I say everyone, all the central banks, they're all leaning towards, hey, there's going to be a cut next. I remember, you guys might remember this earlier last year, like in the spring, after the Canadians did their last rate hike, I said, hey, the next move by Bank of Canada would be a cut. And I think some people interpreted what I was saying was that the next meeting there will be a cut. What I meant was that, hey, there's no more rate hikes happening, so then by default the next move will be a cut, and you don't know when it's going to happen. But we're still sort of in that game right now. But the Fed meeting yesterday, once again, it pushed everything out a little bit further, and it's creating some real headwinds. And I have some ideas of what might happen with markets between now and March the 20th, the next Fed meeting. So what did you hear, Rich, when you listened, watched, felt the vibrations?
I mean, same as you. I thought was interesting, just so people sort of understand that there's always like market reactions when when the markets don't quite anticipate what's going to happen. And what we got yesterday was exactly that. So maybe it wasn't, let's say, what Powell came out and said wasn't, let's say, dramatic, but in the sense that it wasn't revolutionary to say that, inflation is still an issue and they're not quite ready to cut, etc. But what was interesting was the NASDAQ was down almost 1.7% on the day. And that was, and then it fell again towards the end of the day, all the way, I'm looking at it right now, almost 2%. So that tells you that, and the reason that the NASDAQ is tech heavy, sort of a long duration assets that are linked to sort of financial conditions. And so the movement that we saw in that equity market tells you that the market it was caught a little bit off guard, let's just say. I think speaking on that theme of being off guard, I think everyone is just like, I'm a little bit of a contrarian, so forgive me, and maybe I'm being maybe too aggressive in my language, but I think there's just not enough risk of inflation sort of reaccelerating being priced in either to the equity market or certainly what's priced into our little WERP function, the Fed futures, the Fed fund futures rate. So like the bets on what's going to happen. And he didn't really mention that at all. But to me, I think the takeaway from the CPI from a couple of weeks ago and today, the ISM prices paid, which we'll get into in a few minutes. I feel like in just general, everybody's so convinced that, we're going to have this very obvious, clear glide path towards lower rates. And I just can't help but kind of hope that the market's going to be a little bit wrong on this. But so that's sort of my takeaway.
Why do you hope them to be like, what, let's sort of talk about that. Like, what would be the reaction if central banks don't cut aggressively, or what if there are no cuts the next 12 months?
Well, I think the reason I think hope is the wrong word. I just think, I like the volatility. I think it's fun. I think it's interesting when sort of the market thinks one way and it ends up being the other, or the narrative is sort of proven wrong. And I think that's I frankly, I genuinely believe that there's just a lot of inflationary impulse that's still in the market. And I think that you could make the case that that Fed policy is still too easy, and that we've actually seen a lot of the financial conditions ease over the last, let's say, 6 months. There's different ways to calculate financial conditions. One is like, spreads, which are super tight. the behavior and surveys from banks and other sort of financial intermediaries. There's the Bloomberg Financial Conditions Index, which you can Google. There's the Goldman Sachs Financial Condition, and all these numbers have gone up. That is to say that the financial conditions are way easier than they were 6 months ago, and the Fed hasn't even cut. And that's on the backdrop of really big deficits, improving sort of consumer confidence. Anyways, I just think, yeah, Steve, I think it's just interesting.
I think that's like a kind of like an interesting framework to use even just for the Canadian space, because like a lot of the conversation that I'm having today with like people that are in the real estate industry that I think are eternally optimistic, of course. But like, what we're seeing and hearing right now is hey, look, sentiment's getting better. The Bank of Canada's, done. And like he said, probably the next move at some point is going to be that cut. And so everyone's like, hey, this is going to be like a ripping hot spring market. Like things are getting better. And so I kind of wonder what that is, if everyone's kind of starting to front run the BOC. Do you have a situation where housing kind of accelerates, prices start going back up? And if you're a Tiff Macklem at the BOC, you're going, well, why am I cutting? Do you just then push those rate cuts further out? Like we saw this last year in 2023, right? Like housing, basically the Bank of Canada, I think, came out in January of 2023 and says that we're done. We're basically going on hold. We're pausing. Housing ripped. And then he had to come back in what was it, like late spring, early summer to re-raise rates another, whatever they raised, another 50 basis points. So I do wonder that it's almost like careful what you wish for. If financial conditions ease too much, stocks push higher, housing reaccelerates higher. You have to think that just pushes the odds for rate cuts further and further out.
So what I love about hearing this, I have a question for you before I give you my wisdom here. Again, we've had this 10, 12, 15-year period or era of where we've had, free money. The whole world has been able to borrow excessively at incredibly low rates. And then when you had to roll over that debt, whether it's a mortgage or something else, you were able to do it at an even lower rate. So the challenge we have here now is that from an economic as well as cultural perspective, it's the expectation that rates have to go lower. And no one's prepared in case that they don't go lower. And so that, I think, you raised a good point, Rich, there a few minutes ago. Hey, maybe what if they don't go lower? How does everyone react to that? And, we'll all adjust for it. That's the way all spending will have to adjust. You have no choice about it. And companies will make adjustments and banks will as well. But, this obsession with rates, they go up, they have to immediately come back down. Like there's no discussion that, hey, maybe they'll stay flat or maybe they won't come down, or the expectations are just completely, crazy and wacky. And I think that's the risk we have. So Steve, for example, back in December, what were the estimates then for, let's say, 3 and 5 year fixed mortgages were being offered at? And how is that today? Have they changed, or are they a bit higher or lower?
Yeah, I mean, most people have been borrowing, like, I think, let's just use a 3-year fixed rate because that's what everyone's pretty much borrowing these days. The days of doing a 5-year fixed or a variable are not really happening anymore. People don't want to lock in today's rates for 5 years because they feel they're going to come down, but you want enough sort of peace of mind security. So that 3-year term is kind of like that sweet spot that really, since the rate hiking cycle began almost 2 years ago, that's kind of what everyone's basically pivoted to. So that 3-year fix, like in the fall of last year, was as high, it reached as high as about 6.3. And then it just really collapsed into December, where, we were kind of in the low 5s, 5.3. We got down to as low as like 5.1. We kind of reaccelerated. We're basically still at the same spot where today, you're about 5.3 is kind of the number. So, and we're kind of,
and what was it, say 3 years ago, like back in 21 and 22?
Oh gosh, I mean, most people were doing like 5-year fixed, right? So you could get a 5-year at, 2.2.
Yeah.
2 point. I mean, during the depths of the pandemic, I had clients locking in 5-year rates at 1.3. Right.
It's free money.
I had one guy lock in, and keep in mind, 10-year rates in Canada aren't very common. Most people just have never really done them. But I had one guy who did a 10-year fixed 1.8.
That's
So,
fantastic for that person. Really good.
But yeah, I mean, obviously today it's
So he was smarter than the Minister of Finance in Ottawa. Hey, they locked everything in at what, Rich? 1, 2, 3 year maybe.
Ridiculous. Glenn, rates are our all-time low. What did he say? You tell me. I screwed it up.
Rates are
all-time
historical
lows,
Glenn.
That's right.
Don't forget to tilt your head and
that's right, and do a really condescending like. Just to put some numbers just for people who are obsessed with these rate cuts. I mean, U.S. nominal GDP growth is about almost 6%. So, and we have CPI, which bottomed in October, November. You could argue it bottomed in June, is now at 3.4%. Core, excluding energy and food. Again, the wisdom of excluding energy and food, it could be argued some other day, but that's at 3.9%. And the target for the Federal Reserve is around 2. Now, yes, they target core PC, but I mean, it's just, to me, I don't know.
Well, people
like
always find a number. They go like,
Yeah.
core PCE. If you do
exactly.
if you do the 3-month, average, or the 3-month annualized, or whatever, 12-month, what I mean? Like, everybody finds this like data point. They're like, hey, the Fed should be easing, and they should be doing it right now. And like,
exactly. Or trueflation. I mean, one of my colleagues,
I do like trueflation, as at least we cut through the bullshit. But
yeah, Amit, who's a really smart trader on the desk, he never fails to remind me that trueflation is just continuing to go down and down and down. Maybe that brings us to the ISM price.
By the way.
Yeah, that's it.
1.8.
So shout out to Amit, a smart guy. So who knows what's gonna happen? I don't know. I guess I like it when everyone's going like looking left and then the answer is right, or the opposite. I always find that it's more fun that way.
Rich, here's a good looking left for you. So right now for the Americans, so for the Fed, the expectations right now, so for 1 year from now, that the Fed would have cut rates by almost 200 basis points. So 175. Yikes. That's pretty big. That's a significant move.
Even for a real estate guy, that seems optimistic.
Yeah, no, I know you guys like big round numbers, right? That's why I said 2% and not 175. But if the Americans are cutting by 175 over 12 months, that tells me that the rest of the world is in trouble. So it will be similar to the 2018, I think it was 2018 experience. The Fed was always hiking every second meeting, 25, nothing, 25 again. And they were so transparent with what they were doing and where they were going. And then finally, the emerging market world first, they just buckled. They said, hey, we can't handle this anymore. So again, if the Americans are cutting by, 175 over the next 12 months, my view, we could be right or wrong, take it for what it is. It's not that, hey, growth is awesome. They're able to let some more juice out and stuff like that to keep things running. It means someone out there is, really feeling it. So they would have to try to deflect assets out of the American market or economy or the US dollar, basically, to push it back out. And then that's the way that you should view these rate changes.
So Powell's.
There's one more quick point. Oh, sorry, just Steve. One more quick point is that we also didn't even mention the labor market, and so people need to understand the Federal Reserve has a dual mandate. There's full employment, whatever the hell that means, and inflation at close to 2%. Although that's not exactly clear either. But the point is there's a dual mandate. Unless you have weakness in the labor market, which we haven't seen, initial jobless claims are down, continuing claims are down. You're having some key sectors that continue to show decent wage growth, like non-residential construction and other parts of the economy. Unless you get weakness in the labor market, I don't think any of these cuts are coming. But sorry, Steve, please.
You had a soft ADP number this week, didn't you?
That's true. But the ADP
That's like
is like
that's private payrolls and
ugly...
everybody. Everything's volatile, and noisy. What data set are you looking at? And
Yeah, but it's the ugly duckling as far as labor market data points come out. So who knows? But no, it's a fair. You're right though. It was a very weak number from the ADP. So maybe we're just about to get it. But anyway, there you go.
do you see like? I mean, maybe it's like times confirmation bias, but it feels like every day there's like a new company that's announcing like job layoffs. And I always find that interesting because it's like, you see all these big tech names or, I think it was UPS. UPS just like, I think laid off a bunch of people, revised their like guidance lower. And you're like, well, hey,
I
that's
think though I think I actually have a list here. So, companies that we've heard of that have made job cuts recently. You Google, Amazon, Citigroup, eBay, Macy's, Microsoft, Shell, Wayfair, all the banks have done job cuts, and even Enbridge, up here in Canada. I think though the UPS one might be somewhat related to the big union new collective bargaining agreement that they signed a few weeks or a few months ago. It was very generous, for the workers, which of course would squeeze margins for UPS.
So they cut 12,000 jobs basically.
Yeah, so that's how you offset, your soaring labor costs. You just have less people to pay them to. But it's a big deal. But that's the big difference though between FedEx and UPS. Like the underlying business is a little bit different, but one is highly unionized, and then the other one is less so. And I know you have the difference between, air and land and things like that. But one is run more, I might be wrong. It might be more, not franchise, but independent contractor type business lines. And
But those would be like those shipping companies would be like good bellwethers for economic activity.
Yeah, absolutely.
And they both
trucking companies, shipping, but so is housing, and housing
rail?
ones are starting to rise. Rail, all that transport stuff. So there's just to reiterate your point though, Steve. There's a data series called the Challenger, Gray, and Christmas. I don't know why. I guess those are the authors of that. And it's called the U.S. job cut announcement. So you can Google that if you want to. And that actually just spiked. So I thought that was pretty cool. So it spiked last year around this time. Remember when all those tech companies were laying people off? And it got up to, I think, about 100,000, or maybe more. But anyway, so the last data point just spiked from the lows of December all the way up to 82,300. I'm just looking at it right now. So that just sort of corroborates what you've been saying.
Yeah. Well, I mean, to summarize Powell's comments here, I thought the one, soundbite was interesting from him. He says, it will be appropriate to dial back at some point this year. March is, quote, not the most likely case for the first rate cut. So, kind of push back on how soon, but they certainly did signal that there appears to be like a bias towards easing at some point later this year. But we'll see how far that gets pushed out. Speaking of,
oh wait, Steve, just to sort of add on to that to everyone. Remember, this is an election year. So the election is in November, for the Americans. And so that likely means the September meeting and likely the November 7th meeting are off the table for doing any cuts or anything like that. Because, traditionally they try to, remain neutral somewhat. If that's the case, it means we have 3 meetings coming up where it would be a live meeting. So you rule out the March meeting because you just said, hey, we're not going to cut rates in March. So that means then you have May, June, and July is live meetings. And the markets right now are pricing in about 75 basis points in cuts. So if you do 75, then nothing in, say, September or November, then you're looking at 100 for the last end of the year. Again, like things don't reconcile. Hey, do you know what I mean?
No, it's a really good point. Actually.
Yeah.
So don't make any big investment decisions on the hopes that rates are coming down. We just have to, maybe 5 is the new normal.
I have another thoughts. Yeah, we're not letting this go, are we? Like, well,
no,
I'm not.
Go for it.
Yeah.
I think it's interesting.
Well, so right now we have, so the next Fed meeting is March 20th, right? So, here we are Thursday, Feb 1. Yeah.
Yep.
So that's, we got a few weeks here before the next meeting. Markets could force the Fed to cut in March. And by doing that, you sell off, you have this risk off market experience. 1 week, 2 week, 3 weeks, all of a sudden, everyone's asking for cuts, and it could sort of create itself and force the Fed to do something, because the Fed has been forced to do things a lot over the last 6 months, not necessarily with rate changes, but with their speaking, the words they're using, their language and stuff like that. So don't underestimate the power of markets to sort of go to get the Fed or even the Bank of Canada, to do what it wants. That's it now, Steve. No more for me on the Fed.
Well, no, just interesting just seeing the market reaction over the last few days. There's quite a few news stories going on, but obviously you got bond yields actually falling, Rich. So bond yields have been pushing lower. A lot of this actually has to tie into what's happening with the banks. Some of these banks that are tied into these commercial real estate loans. Of course, we flagged commercial real estate, over a year ago. I think everyone's kind of known it's like this problem that's kind of just behind the scenes. But at the end of the day, it was almost like a forgotten story. But banks, just for a reminder, banks are facing roughly $560 billion in commercial real estate maturities by the end of 2025. So, there's a lot of bad loans, particularly in the office space, that are coming up for renewal. And, what's going to happen with these assets in a liquid market. And so I don't know if you want to walk us through that, Rich, what's been going on with some of these banks.
So I think it's important that people just maybe some context, and then I'll set it up for Keith, and he can sort of give us his view on what he thinks might happen. But just so people understand, commercial real estate is like an umbrella term for a whole whack of different types of corporations, buildings, stuff. There's offices, that makes sense, apartments. There's things like self-storage properties you see on the highway. As you drive, I feel like whenever I'm driving away from my mom's house, I always see them. There's industrial parks, and I mean, not just industrial parks, but industrial warehouses. I mean, I guess that's self-storage, but not the same. Do you know what I mean? Then there's malls. Remember a couple of years ago, malls had a big sort of comeuppance. No one wanted to go to a mall. I'm not sure if people still do, but there was a huge, and so when you talk about commercial real estate, that's what we mean. And not all of them have sort of have felt the same pain. So malls, which had their reckoning several years ago, actually have actually not done it that badly. I think they're actually up depending on how you value them, because they had already sort of had their bottom. Industrial parks flat, self-storage. The real pain is in the offices, and then certain types of apartments. And so the offices is where, that's really where a lot of this exposure is. It's generally in the US, and I don't know, Canada's only got 6 banks because we love oligopolies. So I can't really speak to how that, exposure is spread out. But in the US, it's really sort of the smaller regional banks that have a big time exposure to these commercial real estate businesses. And the problem is that the way that these banks are often lend to these companies is, I think, forgive me if I'm fuck this up, but it's like a minimum of a loan to value of like 50%. And so if let's say occupancy rates go down, or the value of and that's how you sort of view or value the property. If that property price goes down, then the loan to value needs to be topped up. And in some cases, people are walking away from the mortgages. So that means that equity piece, there's like the loan piece and the equity piece, that equity piece is going to zero. And then some of these banks are having to step in and absorb these businesses, these properties. They don't want to do that. That's not the business that they're in. Sometimes they're forced to. And so that impairs on their own balance sheet and their own equity positions. And so you've got sort of a cascading effect there. As we know, it's very expensive and cumbersome to readjust or reposition these office buildings to make them residential. In some cases, it's literally impossible. You can't do it. And so you have huge impairments and huge losses on these different either banks, but then there's also real estate investment trusts. There's private equity capital that exists. I guess there's some high net worth individuals that own these properties, and depending on how levered they are, that's where the pain comes. It's also depending on where these properties are. So occupancy rates in loads of American big cities have fallen a lot. In Europe, Stockholm, Milan, Paris, London, that's not true at all. People have returned to the office for multiple different reasons, and so your occupancy ratios haven't fallen at all. You've been able to drive up rents, and so the exposure, the type of asset, the type of financing, it's not at all a homogenous sort of asset. In the same way, let's say government bonds from a specific country are. Anyway, sorry, I know that's like on and on a bit, but I think it's important people sort of have that context.
Yeah, just to summarize on the banks. So it's New York Community Bancorp's decision is slashes dividend and stockpile reserves, sent its stock down a record 38% this week, with the fallout dragging the shares to a 23-year low on Thursday. And that selling bled into Europe and Asia, where Tokyo-based Aozora plunged more than 20% after warning of U.S. commercial property losses, and Frankfurt's Deutsche Bank more than quadrupled its U.S. real estate loss provisions. So it's kind of emanating across, across the world, and obviously we're seeing that reflected, I think, in the bond market, despite some hotter than expected ISM prints this week.
It's kind of odd to hear Deutsche Bank is involved with writing off assets.
Oh my God. I mean, it's great. There's some numbers though out of San Francisco. I'm just reading this right now. So the Aon Center, the third largest office tower in Los Angeles, recently sold for 147 million. That's 45% less than the purchase price in 2014. So you can imagine that's happening everywhere, and money goes to money heaven. It's just these valuations are vaporized. Companies will literally go bankrupt. They'll walk away from these loans. There's also multifamily, which we don't talk about enough in Canada. It's ripping because we have rents that are going up like crazy. We have vacancy rates that are basically at all-time lows nationally. In some places, I don't know about Calgary, Steve, but I know nationally vacancy rates are at all-time lows. Where it's in the United States, it's not at all the same. You actually have there's gluts of multifamily. So in the South, multifamily delinquency rates are sort of back to all-time highs that you saw in 2008. So there's all kinds of different moving parts in the corporate real estate game. But the point really, Keith, is that there's a lot of pain, and I don't think we've seen. I think there's loads more to come.
Well, just on the Canada-US front on the rental market, I mean, we've chatted about this quite a bit on the show, which is you're still seeing rent appreciation accelerate to the upside, which is obviously impacting the Bank of Canada's job in terms of getting inflation down. Whereas in the US, you're actually seeing some of these markets, particularly in the Midwest, where you're actually seeing rents declining on a year-over-year basis, because basically they've been building a lot. During the pandemic, it was like everyone became a real estate syndicator, private equity shop, and plowed money into developing multifamily real estate. So you're actually seeing those declines. Of course, in Canada, when you're adding, 1 million people a year, there's a news story out this week that there was 25 students renting in a basement in Brampton, Ontario. 25 students, which is like nuts. The mayor came out, had this big speech, and was like, we need to put an end to this. And now they're trying to put in more restrictions for Brampton landlords and how they rent out their basement units. So this is the problem. I mean, obviously, again, Rich, you've been all over this from day one, so we don't need to get into it. But if you look at Canada, CMHC just put out a 100-page report. If anyone wants to go check it out, just Google CMHC. Canada's nationwide vacancy rate is 1.5% for purpose-built rental apartments, 1.5% across the country. For condominium units, which is privately owned individual condo units, the vacancy rate is 0.9%. So Canada is still struggling with a supply-demand imbalance on that front. And so I think there's, coming back full circle to commercial real estate, there are obviously a lot of nuances involved.
I forget what the original question was. You guys just
You falling asleep over there?
A
Keith, I have a
little,
question.
but
Keith, I have a question for you. I have a question
yeah,
for you, Keith.
shoot.
How much, you know, how we know that, like, for example, TD has a huge footprint in the northeastern part of America through their asset management business. How much exposure do you think some of these Canadian banks have in the commercial real estate game in the US and in Canada? And do you think we'll see some of that like leach over onto the balance sheets here or not?
It's a good
I
question.
know
I mean,
you're not a banking expert.
I'm pretty good around. I can maneuver around the financial statements pretty good, actually. Traditionally, commercial banks' exposure to commercial real estate is a lot less than their exposure to residential loans, right? So it is what it is. The exposure can be, I guess you pointed out earlier, which can be very specific in in the commercial real estate world, like industrial or something like that, and from a geographical perspective. So, I mean, we don't talk about individual banks and companies on the podcast and what they might have or may not have. But for these big banks, if this is something that's going to start to move elsewhere around the country, then yeah, most banks are going to have exposure to it. But I think the bigger picture right now for this, the small bank in New York that we reference and the Japanese name, it just shows that, on the fringes, there is stress out there still. I mean, remember, one person's loan is another person's asset. So that's what's getting in trouble here. The banks have an asset, they have to write off a little bit. And on the face of it, though, we're painting some stories here where there's a lot of negative stuff happening, but the overall aggregate economic data come out, I think that you'll jump into next. It's still okay in both Canada and the US for different reasons, of course. The American data is different than the Canadian data, largely because of the contribution from the population side. But if you have a healthy banking sector, then that's really great for your economy. If it's starting to deteriorate in credit quality or loan volumes, then that's something to keep an eye on. And it's very clear right now, we're on the latter part for the economy, because we are seeing loans that are starting to go bad. Banks are provisioning increasingly more credits. What they're charging on rates or yields is a little bit higher than before. So again, like nothing is screaming here yet, but it is at a point where, yeah, you had my curiosity, but now you have my attention, with that story.
Speaking of this real estate crisis, though, like again, it's kind of just emanating across different parts of global markets, right? So we've seen Evergrande, for example, which was China's largest real estate developer, has been put into liquidation. So the company is basically selling off all their assets. I mean, they're effectively done. And then, there's worries that this is going to emanate into Country Garden, which is China's second largest property developer. So they're going through a lot of problems over there. Of course, the world's second largest economy. Does that potentially bring in a wave of deflation or disinflation, I should say, to the rest of the world?
Well, it comes back to this, there's this era of free money, that we referenced earlier. And, there's no miracle growth story out of China. People have been saying that for years. And, it's not a miracle. It's just, that's what you can do when you borrow a lot of money and you keep borrowing on top of borrowing on top of borrowing. It takes more debt to produce the same amount of economic output. So for these guys to start crumbling or going under, and Evergrande, changes their name to Nevergrande and stuff like that. A lot of it is due to the economy sort of slowing a bit in terms of efficiency, but to this higher rate story. And, again, I think this expectations for that everyone, for most people, what they have is that, hey, we're going to go back down to 1% again with rates, or 2%. Again, like, be careful what you wish for. Because again, if we're going down, like, again, it's our view. Hey, maybe this is the next thing the Loonie Hour is ahead of, in the game, is that if the Americans are cutting rates by that much, Steve, it means the emerging market world, is crumbling, which is kind of ironic because it's at the beginning of every calendar year, I've seen it now in January as well. All the media and talking heads are out about the best opportunities are in the emerging market world again. It's like clockwork all the time. Emerging markets, la la la, and then as the year goes on in fourth quarter, it's like it wasn't that good, but maybe next year it'll be the one. So
How are
that's
you
where we
looking
are
at
again.
how are you looking at Hong Kong? Are you focused on that at all? And just in terms of, again, the property woes that are emanating in China, obviously trickling over into, the Hong Kong equity market, banks over there, et cetera. I know mutual friend there, Kyle Bass, has flagged this quite a bit. Anything of concern there? Are we slowly getting to this point of maybe this trade finally working there?
I think if you're a proper investment manager, you have to be aware of what's happening in China and Hong Kong, and not from a perspective that you're going to invest directly in that market. It's from understanding and appreciating what the risks are that's coming out of that market. Because if that market does overwhelm itself, it rolls over. That's what it looked like is happening now. It's going to have a huge effect. It is a deflationary effect, as you mentioned, Steve. But with Hong Kong now, I mean, the number of the valuations of banks, look at their loan portfolios and things like that. Nothing is good for that market. And for anyone who's comparing metrics out of Hong Kong to metrics from 10, 20, and 30 years ago, that's wrong, because it's completely different. It's no longer an independent market. It's completely controlled by the CCP. And again, they're struggling. They're really struggling to retain capital, because when capital leaves the system, it's not going to go back until you feel confident you can get your return of your capital, instead of return on capital. So we're watching that market very closely, but not as a place to buy, just to understand it better.
So yeah, my view on China is a bit sort of more generous. I think China has pulled hundreds of millions of people out of poverty, and you don't do that unless you have some improvements in productivity growth, regardless of whether that was funded through credit or not. They're the largest exporter in the world to most major countries. They dominate the consumption of virtually every commodity that you can think of. They're one of the world's largest steel producer. They're one of the largest ship manufacturers. So the idea that the economy is just purely a house of cards, I think, is not accurate. I don't think that can be supported by the data. And maybe that's where Keith and I sort of butt heads a little bit. But I think the more general point that right now you have a severe deflationary force in China, I think is unambiguously right. New home prices, according to the official statistics, which to me sound laughable, are down negative 1% year on year. I think that's kind of a joke. That's probably much more. Used home prices are down 5% year on year. I think you could probably triple or quadruple that. And so there's definitely sort of something's broken in that housing market where the average Chinese person is no longer viewing housing as a way to protect their capital or investment for their children. In Hong Kong, I'm just looking at the series right now. Residential prices, property price index, according to the Bank of International Settlements, is down 20% from the peak. And that's an average number. So you can imagine there are some property prices that are probably way, way lower than that. And in Hong Kong, unlike Canada, where I think banks are probably leveraged, 10 to 1, Keith? I mean, in Hong Kong, the banks there are leveraged probably 20, even higher to 1, 20 to 1 or even more. I think the thing is what we sort of forget about the command economy in China is that, several years ago, they made a concerted effort to pull their economy away from real estate, right or wrong. And I think we forget how powerful that political impulse is, right or wrong. I'm not making a value judgment. I'm just saying that's what happened. And so there's something called fixed asset investment in China. And you can Google this if you want. And they are focused on spending that. They're focused on allocating capital towards electrical equipment, auto manufacturing, which is up 20% year on year. They're dominating certain parts of the electric vehicle market. So again, I think in a sense we agree, but we sort of come from different places, Keith. Like there's definitely deflationary force out there, but I guess I'm just have a more generous view. Again, I wouldn't invest my money there. I'm saying from an economic perspective, that's what's going on.
I think this brings up like an interesting point though, right? Because everybody's so focused on the US and waiting for the US to break, right? Everyone's like looking at the data, following it religiously. When's the Fed going to cut? And again, to your point, like there's no glaring recession, at least in the US. However, you get, places like China, which are clearly undergoing some difficulties, Europe. I don't know if you want to touch on that. There's clearly some stuff going on over there. So like these are two real large economies. So if we're looking for sort of, the excuse to start cutting rates or, some sort of more or less black swan event, it doesn't seem like it's going to be coming from the US.
I mean, just real quick on Hong Kong before we jump over to Europe. Again, all this affects Canada because if we get a crisis of some kind outside of Canada, it will absolutely affect Canadian financial markets, would affect your borrowing, what the Bank of Canada is doing, what's happening to the currency and stuff like that. I mean, so the real challenge in Hong Kong with the banking sector, they're already over levered. So I think Rich, you referenced Canada. Just say we're levered 10-1.
Yeah, that's what I
So
said.
for every, just say one of the Canadian banks has $1 billion in equity, it means they have another 10 billion in loans on top of it, as an example. And if you get 10% loss on that 10 billion in loans, it wipes out your equity, right? That's the way it works in simple numbers. In Hong Kong, they're levered multiple times more than the Canadian banks.
I thought it was about 30-1, right? Maybe more.
Yeah, it could be. And but what's happening is that increasingly the number of loans that are on the books, from the real estate market, they're increasingly going underwater. So the loan to value is now at, it's a negative number, or got it that way, or more than 100%. And the banks, if you start writing that off, it means their equity goes to zero. Then they have to raise equity. And then the other challenge with it is that they need US dollars to operate. But the most important bank for China and Hong Kong, it is HSBC. So HSBC, it is the conduit for China and Hong Kong to have US dollars, coming in and out of their market. And so what we like to do, whenever you get the results coming out, from HSBC, you get a real good opportunity then to glimpse to what's happening over there. So I haven't checked their earnings cycle. I'm not sure when they're up next, but that's something to put on your radar. But again, watch this market because it can really affect everyone else. Maybe not though nearly as exciting as the Europeans and their fantasy land they have over there. What's happening in Europe, Rich?
Well, I mean, Europe is committing ritual suicide. I think it's called Sakepu, right? The Japanese, what are the Japanese is like the Japanese samurais when they sort of commit suicide when they have dishonored the shogun. I mean, that's basically what their industrial policy. Again, people don't like to hear it, but it's the truth. This insistence on green energy, shutting down nuclear power plants. All that stuff is effectively has pushed up their energy prices. Yes, also because of the Russia thing, that's part of it. And effectively, what is happening is their industrial sector is I don't know, hemorrhaging is the right word, but is under immense pressure because they are unable to compete on the global stage. How do I sort of support that view? If you look at sort of energy producer price indices, they're almost 2.5 times what they were. Sorry, energy producer price index is almost 2.5 times what it was in 2019. You imagine these are normally businesses with really small margins. So if your largest input cost has 2.5 times what it was 3-4 years ago, it makes it impossible for you to run and just quickly. A lot of these companies basically turn energy into goods. We're seeing sort of, if you look at the PMIs out of Europe, they're below 50. Manufacturing sector is 44. These are abysmal numbers. And then we've recently just saw Germany's real retail sales. I think it was down negative 4.4 year on year. Now that's not a seasonally adjusted number, mind you, but you can imagine that real retail sales is contracting almost 4% year on year. I mean, so And it's really just a function of sort of just bad industrial policy. Germany, just so people have some context, Germany's GDP is about 27% of euro area. The next biggest country is France with about 20, 22, then Italy, sort of the next one is Spain. And then there's a big drop off, I think Netherlands, Belgium, and then the rest. And there's just the very long tail.
What about the
but just
Swiss?
so
What about the Swiss?
No, the Swiss is not part of the euro area. That's a good question. The Swiss economy is doing pretty great, even though their currency is doing really well, and because they're not run by idiots.
What about Denmark? Denmark. What about Denmark?
Denmark's not part of Europe. But anyways, my point about
Wait a
Germany.
second. How can Denmark and Switzerland not be part of Europe? I don't understand.
They are no, sorry, excuse me. They are part of Europe. They're not part of the euro area.
And how do you fit Norway into it?
Norway is also not part of the euro area, but these are part of the European community, so they share a free trade agreement, but they don't share a currency and they don't share the same central bank. So Norway has its own central bank and its own currency, and so does Denmark, and so does Switzerland. And Switzerland's not even part of. That's like its own. Europe's complicated.
What about the Swedes? I mean, they've been around. They must be part of Europe by now.
They're also part of Europe, but not part of the euro area or the EU technically, but they do have a free trade agreement. Anyway, Keith is busting my balls, and it's not fair. When
is the election for the president of the European Commission? I'd like to see who's running. God.
Anyways, one thing that's been really strong in Europe, and I wrote about this a couple weeks ago, is the service sector. Believe it or not. But that, but we're starting to see weakness there too. I don't know. Europe is in trouble, and it's largely a problem of its own making, which is, in my view, probably the most frustrating thing. And I guess we're not the only ones that are frustrated about that, right, Steve? Farmers now protesting in France too?
The farmers are out. I don't know.
So it was Germany 2 weeks ago. I can tell you, it was Germany 2 weeks ago, I think, or 3 weeks ago. And now in France, the farmers are protesting again. It's all the same shit, basically. It's the clampdown on for use of fertilizers, squeezing these people and how they produce goods. And then
started by the Dutch too.
Started by the Dutch. No, I thought it was started by Canadian farmers.
Oh, I don't know. They need to start freezing accounts. Get this.
That's what they should do. They should just freeze their bank accounts. That'll sort it out. But anyway, back to Europe, just to quickly put a bow on it. I mean, it's just not looking good. I mean, and I think although there are some spots where it's okay, like travel, the euro is at really, really cheap relative to the US, might hit parity again. Who knows? In general, there's real pressure on the industrial base of Germany and the rest of Europe, and the ECB is probably going to be the first to cut, I would say. But maybe
do you think there's quite a few obvious signs there in terms of deflation?
Yeah. So unlike US, where again, I think inflation is going to creep back higher, in Europe, it's not at all the same. You have no credit growth in Europe. So bank intermediation, financial intermediation is paramount in Europe. So like, unlike in the US or even Canada, you have like a corporate bond market. In Europe, it's all bank lending. And bankers are rightly quite conservative. And so bank lending to non-financial corporates and houses is, if I'm not mistaken, negative across the 4 major countries. And so unless you have some kind of credit intermediation, you have a weakness on the industrial sector, you're seeing that inflation numbers come down fast. Even the housing sort of is rolling over. So yeah, it's trouble. It's trouble for the ECB. I'm surprised they're so hawkish. Sorry, Keith. Go.
Yeah, they're actually turning a bit dovish. I mean, so right now they're estimating that they could begin cutting, pretty soon. But I mean, the real challenges with Europe, and they haven't been fixed. They're not even being addressed, and no one talks about them. They have no there's no common treasury for the Eurozone. There's still. Is it 20 members now? I know I was sort of
19
fun with you there earlier.
No, it's all good.
Is it still 19? Okay.
Yeah.
And so everyone is still running their own treasury, what they're collecting and spending and taxes and everything. But most importantly, there's no federal debt for the Eurozone. So that totally creates a void in the world for competition for global capital. So if you want to park your money or you want to park it overnight in something liquid, it's only the US. That's it. You can't go into the Eurozone because then you have to pick which one are you going to buy. You know, you're going to buy German debt, which we're finding out now, you know, the German economy is coming off. But then the other challenge with Europe, of course, is, you know, this whole geopolitical, you know, challenge they're in. Like, they are not energy independent at all. They are energy dependent, and they're dependent on some guys the Americans don't want you to be friendly with. So it's, you know, and the world is increasingly, you know, going down this path where, you know, we could have war or conflict of some type coming up. We're expanding from where it's taking place right now. So Europe is really in a hard spot, and it doesn't mean we can't get out of it, but they can't get out of it on their own. Europe is isolated, and it needs the world to improve and to calm down for it to do better.
There's two more things to just to support that view. So the way, you know, you say it's very dependent on the global cycle, and especially China. So, you know, if you look at, and so is Canada, for example, but, you know, you look at exports plus imports as a percentage of GDP is one way you would calculate trade openness. I understand people might say that that's an arbitrary way of calculating it. Tough shit. That's what we do. You know, that's a way of, and then so, for example, US is, you know, maybe less than half as dependent on the global cycle. Canada has exports are very important. Europe. So if you have a weakening China, which is a large part of the global economy, if you have a US, which is increasingly sort of more isolationist and more inward looking, that, you know, that affects Europe's economy. The other thing that people should know, though, is that Europe's equity market is not related to its domestic economy. The largest stocks in the European equity market are LVMH, SAP, BASF, all these companies. I'm trying to think of other ones. You know, some of the German manufacturers are obviously big, but a lot of the biggest and stocks in that equity market are actually sort of geared to the global cycle, and have actually done really, really well. I think LVMH is one of the best performing stocks over the last 5 years. So it's funny how you can have
You left out all the Swiss companies.
Oh yeah, excuse me. Sorry. Yes, absolutely. Sorry. That's right. No, but in like the Eurostox 50, Switzerland, and Eurostox 600, Switzerland is a big weighting in there, and they've actually done really well, which is sort of the irony of all this.
Well, I think that's a good place to wrap it up. I think ultimately, you know, we've kind of gone around the world, and it seems, the U.S. remains the cleanest dirty shirt in the laundry hamper. So we'll have to keep an eye on the rest of the world here if we're looking for an outlook on when rates do eventually get cut, if they get cut. It seems like they won't be emanating from the U.S. And sure, our boy Tiff Macklem's watching too. So
Hi, Tiff.
Hi, Tiff. As always, good place to end it. See you next week.